This is the In Focus podcast from The Hindu.
Hello and welcome to another edition of the In Focus podcast. I'm your host, Sampath. The Union Budget has announced several changes to the tax regime for long-term capital gains. These changes, which are applicable to all types of assets, have been particularly contentious with regard to long-term capital gains from the sale of immovable property. And the provision that has attracted the most attention is the removal of the indexation benefit in the calculation of long term capital gains. Many analysts now fear that the tax obligations of ordinary investors will shoot up, that black money would flood back into real estate, and that investors might now prefer short term holdings of 3 to 5 years rather than long term ones of 10 to 15 years. And all of these fears, if they were to come true, have the potential to change the financial landscape of the real estate sector itself. Now, are these apprehensions valid? And what do these taxation changes really mean for the average investor? We look for answers to all these questions in this episode of In Focus. And we have with us Ravi Saraogi of Samasthiti Advisors, who's also a SEBI-registered investment advisor. Ravi, welcome back to In Focus. It's been a long time. Thank you so much for joining us again.
Thanks, Sampath. Pleasure to be here.
So, Ravi, to start with, I was wondering if you can give us a quick overview of the various changes, in the short-term capital gains taxation regime, the long-term capital gains taxation regime, which are all announced in this year's budget. What was it before the budget? What was the earlier regime? What it's going to be now across asset classes? To do with holding period, the applicable rates, etc. If you can just give us a quick overview of it all.
Sure, Sampath. So let's talk about the most significant changes. So let's look at capital gains on equity first. And what has happened is that the short-term capital gains on equity has been increased from 15% to 20%. The holding period continues to be less than 1 year for classification as short-term. What has also happened is that the long-term capital gains on equity has been increased from 10% to 12.5%. So it should be noted that long-term capital gain tax on equity was actually zero, before 2018. So in 2018, the government introduced 10% long-term capital gain tax on equity. And now this 10% rate has been taken higher to 12.5%. So my sense is the government is moving in the direction where short-term capital gains may gradually be increased to the slab rates.
What do you mean by slab rates?
So by slab rates, I mean the highest, tax bracket or the exact tax bracket at which the individual falls. So it could be that you are going to pay short-term capital gain tax at whatever rate you are paying on your other income. So that depends on your overall income and which tax bracket that you fall in. And I think the long-term capital gains on equity may be further increased to 15%. So I think the government still wants to incentivize long-term investments. So the long-term capital gain tax may be capped at 15%. It may not go higher than that. But I think there is potential in the future for short-term capital gains to be completely be aligned with what you're paying on your other income. So this has been one big change. This has been a tinkering on the long-term capital gain tax on equity. It increases the tax burden for investors who are investing in equity, and that could mean investment in shares or investment in equity mutual funds, for example. The next big change, of course, which has drawn a lot of flack and where there's a lot of chatter as well, is the removal of the indexation benefit for nearly all assets. Indexation was there for real estate, it was there for gold, it was there for unlisted shares. So what the government has done is removed these indexation benefit. So earlier, what you had to do was you had to pay 20% long-term capital gain tax on these assets, like for example, property, after factoring in inflation. So you paid a 20% long-term capital gain tax, but you were given an opportunity to adjust your cost with inflation. Now, in the new regime, you're going to pay a flat 12.5% long-term capital gain tax. There is no indexation benefit, there. So the effect is going to be mixed. There is benefit in the sense that the 20% rate has been brought down to 12.5% rate, but at the same time, indexation benefit has been removed. So depending on case to case basis, the effect will be mixed. My sense is that because of the removal of indexation, I think the taxation on real estate for most investors is going to increase. Even though the government maintains that the new tax will not lead to a higher tax burden, I think for most typical real estate investors, they are looking at a higher tax burden, and we can in subsequent parts of the podcast look at how. If you look at how the government is justifying this move, the government has justified these changes by saying that it wants to simplify and standardize long-term capital gain taxes across different asset classes. So whether it's equity, whether it's gold, whether it's real estate, the government wants to standardize capital gains taxes across all of these asset classes. That has been, the sound bites given by the government for these changes. However, I'm not so convinced, because while yes, these changes in capital gain tax do lead to standardization, but at the same time, the government has also been making several other changes, which is really complicating taxation for an average individual, right? So I'll just quickly take two examples here. So one is in budget 2021, government introduced a regulation that employees' contribution to their provident fund account above 2.5 lakhs. So whatever is the interest that you're earning on contribution above rupees 2.5 lakh in your employees' provident fund, that interest was made taxable, right? But this is not an easy tax change, because it really, really complicates your employees' provident fund account. So now there are two separate stream of balances to be maintained, one less than 2.5 lakh, one more than 2.5 lakh, one income which will remain tax free, another income which will be taxable. So that's a really, really complicated tax change. In fact, even EPFO struggled, to bring its systems in line with these tax changes and do proper reporting. Another example, in 2023, government changed rules for taxation, of income from insurance policies. So for traditional insurance policies where the premium exceeds 5 lakhs, those policies were now made fully taxable. Or in cases where the aggregate insurance premium that the individual pays is more than 5 lakh, those policies were again made taxable now, which is again not an easy tax change, because it forces you to actually track insurance premiums across different policies and to see whether it's below or above the 5 lakh threshold. So I don't necessarily think we are moving towards a simpler tax regime, with these changes.
Right. No, you just said explained, Ravi, how with this indexation removal, even though the government has given a logic, it says that because the compounded annual growth rate of the real estate sector, the returns are between 12 to 15%, and inflation is about 4 to 5%. So therefore, most people will benefit even if indexation is removed. Do you buy that 12 to 15%? Because I do, from at least anecdotally, I don't think most people's real estate investments are growing at a CAGR of 12 to 15%. That is one. And secondly, like how exactly is this indexation calculated? I mean, especially with regard to real estate. How does this whole thing work? And is most people, are they going to be looking at a particular break-even point, like your property value has to increase by 2.5 times or 4.9 times, whatever? Only then it will make sense to sell under this new regime. Otherwise, just hold on to it.
Yeah, I think those are very important points, Sampath. So let's take them one by one. So first, regarding this number which the government has given, which is 12 to 15% increase in real estate prices. So frankly, I'm not sure where the government is getting this data from. I think this number is being mentioned to justify the tax change. because when you calculate the tax liability using inflated price appreciation numbers of 12 to 15%, the tax liability comes down under the new tax framework. But what is the source of this 12 to 15% number, which the government mentioned? We don't know. I think once there was quite a backlash in terms of removal of this indexation, the income tax department tweeted an illustration showing this 12 to 15% price appreciation of real estate and how, because of the change in taxation, the tax liability was actually coming down. But like I mentioned, we don't know the source. But what we do know is that the Reserve Bank of India compiles a quarterly house price index. And this is done for 10 major cities, right? So Mumbai, Delhi, Chennai, Kolkata, Bengaluru, Lucknow, Ahmedabad, Jaipur, Kanpur, and Kochi, right? So for all of these 10 cities, we actually have a housing price index. And based on these city indices, the RBI also calculates an average house price index for the entire country. Now, the data for these indices actually comes from actual registered property price transactions which RBI collects from the registration authority. So it's very, very high quality data. So I was looking at the value of this index from 2012, 2013 to now. So that's about 10 to 12 years of data. And this index shows that house prices have increased by only 4.5% per annum, right? So there's a huge gap between the 12 to 15% number that the government is highlighting and the actual increase in house prices, which RBI measures and which I mentioned at 4.5% per annum. Now, when you calculate the tax liability based on this 4.5% increase in prices, under the new tax regime, the taxation will increase substantially, right? So that's and like you mentioned, Sampath, anecdotally, we are aware that a 12 to 15% appreciation in apartments, for example, this is very rare. There, of course, are always specific cases where this could have happened, but for the vast majority of investors, they are not going to see these kind of appreciation on their apartments investments. In our own financial planning advisory practice, we work with several clients, and we have had several examples where we have looked at data on real estate investments, and 12 to 15% is not the appreciation that we are looking at at all. So this is on your question regarding the 12 to 15% price appreciation. I think it's a figment of imagination. I don't see it happening at all. If you could repeat your other parts of the questions, we can take them.
Yeah, I was just wondering how exactly is this indexation calculated, and is it like that is? I mean, related to that question is under this new regime, would it only make sense for a person to sell his investment in real estate if there is a appreciation of a particular break-even point, like 1.7%, so 1.7 times in 5 years, or something like that? Because my own sense is that without indexation, if you were to sell a house, say, which you bought for 1 crore 5 years ago, and it has appreciated by whatever amount, and if that appreciation is less than the cost of acquisition, which you would calculate using indexation, you would actually technically be selling it at a loss and still paying tax on your loss. Isn't that right?
Absolutely. So I think that's a very good question. And let's look at how indexation works, and that will, I think, automatically answer your question as well. So I think it's important to take a step back and look at what indexation is and what was the context why it was provided. So indexation is essentially a benefit that the government gives you, where you can adjust your acquisition cost of an asset with inflation before you calculate capital gains. So it was made available for real estate and gold investments, and the logic being that these assets are generally held by Indians for a very long period. So, for example, the holding period of real estate can be many decades. Now, over such a long period, the asset's value may have gone up a lot. And at the time of sale, if the buyer has to pay capital gains without adjusting the cost price with inflation, the tax liability can be quite large. So let's take an example. Suppose you bought a property for 10 lakhs in the year 2002, and you sold the property 20 years later in 2022 for 40 lakhs. So the property has gone up in value by 4 times in the intervening 20 years. Your capital gain in this transaction is 30 lakhs. So you bought the property at 10 lakhs, you're selling it at 40 lakhs. So the capital gains is 30 lakhs. Now, under the previous taxation, you will not be taxed on this entire 30 lakhs. Your purchase price of 10 lakhs will be adjusted for inflation. So I did some math, and so based on the cost index provided by the income tax department, your purchase price of 10 lakhs will be adjusted to approximately about 32 lakhs. So the capital gains is only about 8 lakhs. On this 8 lakhs, you will pay a tax of 20%, which is 1.6 lakhs. So you can see how, because of indexation, your cost price of 10 lakhs was adjusted to 32 lakhs, which brought down your capital gains from 30 lakhs to only 8 lakhs, and you paying a tax of only about 1.6 lakhs on that gains. Now, alternatively, because of the removal of indexation, the entire 30 lakhs becomes taxable, and the new rate is 12.5%. So if you calculate 12.5% tax on 30 lakhs, that comes to 3.75 lakhs. So essentially, your tax liability has actually more than doubled. And if you do some math, with different scenarios, it will emerge that for people who have made very good returns on the real estate investments, right, which is far above inflation. So people who have made 15%, 20% return, annualized return on their real estate investments, they will benefit from this tax change. But for most people, who buy an apartment to stay in that apartment and hold those apartments for long periods of time, and those apartments could have appreciated broadly at the rate of inflation, they will have to actually take a much larger tax hit due to the removal of indexation. So now, Sampath, if we come to your other question, right, will this encourage investors to get in and get out of property at a higher velocity? I think yes. I think the velocity of transactions in real estate will increase. Earlier, people used to hold real estate for longer periods to benefit from a good long indexation, period. In that long holding period, there could be periods of low inflation, but there'll also be periods of high inflation where indexation actually becomes very, very powerful. But now with indexation out of the way, there can be a tendency to get out and get in real estate sector at a much larger frequency. So I think this will encourage people to probably hold real estate investments for shorter periods of time.
Right. Now, what is the rationale in fixing 2001 as the cutoff date? I mean, as I understand this whole change, I think properties purchased before 2001 will enjoy indexation benefit, and those afterwards would not. So, wouldn't it have made more sense to have this till July 2024, like somebody who bought a property last year? If they had known that this is the new regime under which they will have to be operating, it's not fair, right? They should have been allowed to exit under the old regime, since they bought under the old regime.
Absolutely. I think you're right, Sampath. So just a small technical correction. So all real estate investments, will not have indexation, irrespective of whether it's pre-2001 or post. What the government has done is that for properties purchased prior to 2001, they can take indexation benefit up to the year 2001. So let's say you bought a property in 1995 or 1990. The government is giving you an opportunity to treat the fair market value as on 2001 as the purchase price. So essentially, whatever were the capital gains prior to 2001, that is getting eroded, and you are getting the benefit, so to speak, of indexation up to 2001. But after 2001, there is no, indexation benefit. I think what should have been done is that the indexation benefit should have been allowed till 2024.
And post that, the 12.5% tax rate should have become applicable. So till 2024, the old regime should have continued. And incremental capital gains after 2024, that's where I think the new tax rate, could have been, introduced. In fact, if you look at the way the government introduced long-term capital gain tax on equity in 2018, there was clear grandfathering of the previous capital gains that the investor had made. So all your equity capital gains up to 2018, that continued to be exempt from long-term capital gain tax, and only the gains post 2018 was taxed at the newly introduced 10% rate. And that 10% has now become 12.5%. So something like this, could have been done. Also, this removal of indexation could have been announced in the upcoming Feb 2025 budget, because what gets announced in Feb 2025, the rules will get applicable from April onwards. So in the intervening months, even though it's a very short period, but still in the intervening months, people could have taken some steps if they wanted to. But now it's water under the bridge, and there's nothing that you can do. I think the government speaks about tax stability, but I think this is a negative for tax stability. Changing taxes which have retrospective effect. It complicates investing, and it complicates financial planning, also for planners, like us. For instance, it unnecessarily leads to fears and anxiety, like what is going to happen to future taxation of some other product. So in fact, if you think about it, there are a lot of concerns now that will public provident fund also get taxed, in the future? It's perhaps the only investment product today which has a triple E exemption. The investment in the public provident fund is exempt. The accrual is also exempt from tax, and the withdrawals is also exempt, right? And people have been using the public provident fund to accumulate, long-term savings, right? And these kind of tax changes creates anxiety and fear among investors that will we in a subsequent budget see these tax-free products being bought into the tax framework. So I think it's negative for tax stability to do this with a retrospective effect.
Right. I mean, it's definitely not a great idea for tax stability if people are going to be on tenterhooks, uncertain, because savings is a long-term proposition. If there is no long-term stability, or if there are retroactive effects to your new rules, I think that's a big worry for the ordinary investor as well. Another concern which has emerged, Ravi, is that the removal of indexation might incentivize people to go into cash transactions, which would of course mean the entry of black money into the real estate sector, because people would want to lower the paper value of the transaction so that they end up paying lower capital gains tax. So, and with this kind of a scenario, of course, it will go to hit the salaried person the most, because their income is purely a white income. So if they want to buy a property where the seller wants some component in black because he wants to pay less capital gains tax, then that's going to be a problem too. So how do you foresee this scenario playing out? Is it going to be incentivizing black money in real estate sector in a big way?
So yes, I think there will be a tendency on part of home buyers and sellers to find innovative ways, just to use an euphemism, to save tax due to removal of the indexation benefit. And we know that such innovative and engineering ways generally involves tax avoidance rather than tax planning. Right. So property is a large investment, and there are few real estate transactions in an individual's life, but those few real estate transactions are very, very bulky, in nature. So compared to financial assets where you could be investing a smaller amount, redeeming a smaller amount, and where the tax may be diffused over many years, in real estate, when you sell and you receive this large sale consideration, and hence an equally large capital gains tax burden, people can get very innovative in trying to lower that burden. And to the extent that this tax change increases the tax liability, I think there is going to be less of a transparency in the real estate sector because of this tax change.
Right. And how do you see this affecting the financial landscape of the real estate market in India? Because when investors flock to real estate because of the returns and the returns indexation adjusted returns that they were enjoying till date, and now that that's going away, and also you have already mentioned how it's going to be increasing the velocity of transactions. How do you see this affecting the landscape of the real estate market in India? Is it going to become more affordable, less affordable, or it won't really matter much?
Yeah, I think it's difficult to say how this will play out in the sector, and we will need to wait and watch. And there are two reasons, for this. First is that some players will benefit from this tax change and some will not, and it's not a clear tax increase. We will need to see which segments do better and which segments are worse off. So we can take examples. So one segment which we think will be worse off is your typical home buyer, right? Who is a middle income earner who is buying a 2 to 3 BHK apartment and intends to use it for a living purpose, right? This type of a buyer generally holds the property for a very long period of time. And we also know that barring certain cases, apartments don't show a lot of appreciation. We talked about the RBI house price index showing an appreciation of about 4.5 to 5%. Now, this type of buyer will be at a clear disadvantage, right? Because, however, such a whether this tax change will disincentivize such a buyer from buying apartments, I don't think so. Even with this negative, they may still continue to buy. That is because this type of a buyer purchases an apartment for non-financial and cultural reasons. There is a very strong preference for owning your own house in India. And I don't think this tax rate change will impact that deep ingrained love, for property. So I think this segment of your typical home buyer will be negatively affected. However, whether it impacts the demand, I don't think it will materially impact the demand. I think people will still buy apartments for their own use. They may lower apartment buying for investment purposes, but that's different. I think the tax change, if you look at another segment which I think will benefit, and hence where the real estate market focused in that segment could benefit from this tax change is.
Okay, Ravi, could you please explain why you think it's going to negatively impact the middle class buyer who's buying a home to live in? Why would it, if he's going to hold on to it for a long time, why do you think it would affect him? He just buys a house and he lives there. So what is the negative fallout of this tax change on him or her?
Yeah. So see, even when a typical middle income earner is buying a property and is staying in that property, the property might still see liquidation at some point of time, right? This could be when the property is seeing intergenerational transfer, where the next generation do not want to hold to it. So we see several such cases where the parents have bought a house, they have raised a family in that house, and the kids are now settled abroad, and the parents are in the retirement, and they're actively considering selling that property because the kids are not going to be able to manage that property from abroad. Or the kids could have settled in some other cities, and it'll be difficult for them to manage that property, when the parents are old. So there is a preference, for giving inheritance in a manner which doesn't become problematic for the next generation. So even when people are buying properties and staying in them, there still could be liquidation of that property. And in the earlier case, they could have made use of indexation. And let's say the apartment has appreciated by 5 to 6% each year. And we know that inflation itself is, 5 to 6% each year. So effectively, in many cases, there was actually no tax liability when people were selling these apartments. Not only for intergenerational purposes, people today, they buy a house in a city in which they are working. So they could be working in a city for 5 to 10 years. There's an opportunity in some other city. So they look to sell the previous property and buy another property in a city in which they are moving to. So because of several such live events, even when somebody is buying a property with a long-term vision, there still could be liquidation coming, and these home buyers will definitely see their tax liability go up under the new tax regime. Now, coming to which is that segment which will actually benefit, I think there is a segment of investors who invest in the real estate exclusively as an investment, and it's not for use as a property, but exclusively for investment. This is generally high net worth individuals. Now, for these investors, because they are buying the property as an investment, the expected return from these investments has to be very high, and that has to be in the range of 15 to 20% at least. Now, for these set of investors who may be earning a very high return on the real estate investments, the 12.5% flat tax on capital gains will actually work out very, very well for them. They will, because the return that they are earning from the real estate investment is far higher than inflation. So indexation is not very useful for them. So they will actually find the reduced 12.5% flat tax on capital gains very, very beneficial. So different segments will be impacted differently. One another segment which I think will benefit is investors who buy plots of land. Generally, if we look at even government, stamp duty rates and circle rates, land provides much better appreciation than apartments. This is true across multiple cities, and the returns can be quite high in certain cases, even though, of course, there are risks of investing in land in terms of encroachment, in terms of not having a clear title. So for investors who are who buy plots of lands, again, the tax change could be beneficial because they could be making a much higher return, than inflation on those, plots of land. So different segments of the real estate market will get impacted differently, and, we'll have to see how it, plays out in the coming years.
Right. Thank you for explaining the impact for different segments, Ravi. So we're running out of time now. Any concluding remarks that you want to add on before we wrap up? So on the whole, I mean, do you think this is for the good in terms of both simplifying the whole taxation, at least with regard to the real estate sector? And I know that you have given good examples of how overall the taxation regime is not moving towards simplification consistently. But in this particular case, do you think this is a plus in terms of simplification, or is it a more of a knee-jerk kind of a move which may not really help most of the people who would be affected by it?
Yeah, so I think if we look at the tax change in isolation, we will have to buy the argument that yes, it does simplify and standardize, capital gain taxation. But we cannot look at this tax change just in isolation. We have to look at the overall tax policy of the government. And there, I think, this argument that we are simplifying the taxation structure, I don't think that broadly holds true. And hence, I don't buy this argument completely that, this is done, to standardize taxations across different asset classes. Another aspect is that whenever we are talking about simplifying taxation or standardizing taxation, why is it that the tax rates always go up, right? And the standardization can also be done by actually taxing certain assets lower and bringing them at the same rate as some other asset classes, right? I'll give you an example. So last year, the government removed the indexation benefit for debt mutual funds.
But this one had a grandfather clause, right?
It had a grandfathering clause, yes.
Not like this LTC long term.
Not like this, yeah. So thankfully, there was grandfathering. And the argument was that debt mutual funds should be taxed similar to fixed deposits, right? But why is it the case that the rate on debt mutual funds has to go up, to the rate of the fixed deposit? Why can't fixed deposit rate be made standardized with debt mutual funds by lowering taxation on fixed deposits? So I think, while it's always nice to think about it in terms of standardization and simplification, there is definitely revenue aspect to this. Tax rates on investments have generally seen an increase. across multiple products. We talked about insurance, we talked about EPF accounts, we talked about debt mutual funds. We are seeing capital gains on equity going up. We are seeing removal of indexation benefits. So I think overall the direction is that investment income is being taxed progressively at a higher rate now compared to earlier. And I think that's a more better explanation for these changes rather than anything else.
Right. I think the broader context in which one might want to view this entire change is that investment income is progressively being taxed more and more by the government. That is the broad direction of tax reform, if you want to call it, or taxation changes, if you want to call it. Thank you so much, Ravi, for coming on board, explaining this so well. I think you've established the broader context and the specific kind of concerns and implications for the average investor. I think people would do well to take all those insights on board as they go about their personal finance decisions. Thank you so much once again. Pleasure talking to you.
Thank you. Thank you for having me, Sampath. It was a pleasure speaking to you.
In Focus will be back soon with analysis of the biggest news issues. In the meantime, you can find our podcast on Spotify, Apple Podcasts, Stitcher, and other platforms. Just search for In Focus by The Hindu. We'll see you soon.